class, as a student, you should be able to define accounting or financial reporting. You should also be able to look at the purpose of accounting, to state the purpose of financial reporting or accounting. We also look in the course, we look at the meaning of the term financial transaction, look at types of business, we look at bookkeeping and accounting, look at the scope of accounting, which few of it will be financial accounting, cost accounting, management accounting, auditing. Then the need for accounting information. Look at the need for accounting information. We look at the qualities of good accounting information. Then we also look at the users of accounting information. And finally, we'll be running the class up with corporate governance. Corporate governance is what we'll be looking at the tail end. Okay. Now, let's go into the class proper. Okay. Now let's look at financial transactions. Financial transactions. Financial transactions are those on which monetary values can be placed. Now, the control word is about any transaction to be referred as financial transaction, its monetary value must be placed on them, and that can be measured objectively. So it's not just placing monetary value on it. Objectivity must play a role in determining what is a financial transaction. They consist of cash transaction, credit transaction, or contra entry. Cash transactions are transactions in which payment is being made in the process of the transaction, or at the beginning, or at the exact point that the transaction took place. Payment is being made. Whereas credit transaction is a financial transaction, a transaction that has monetary value, but which payment was not made immediately. As a result, the customer or the supplier, the customer or the business entity differ payment for such a transaction. That is what we call a credit transaction. A contract transaction may be a transaction between a customer, the supplier, and the firm, or probably within the organization. That is transferring cash at hand into bank and serve as a contract transaction. So financial transaction must be able to cause a change. These are more or less the characteristics of financial transaction. They must be able to cause a change. They must be able to cause a change either on assets, liabilities, or capital of a business entity. It could also be a combination of them. It is the exchange of goods and services for cash in future for goods or services. So, the promise to pay in the future for these goods and services constitutes the credit sales or purchases. So, transaction must have a monetary value that can be placed and that can be measured objectively. So any transaction that can be measured objectively, that has a monetary value, that monetary value can be attached to it, shall constitute a financial transaction. We now move straight to the purpose of accounting. The purpose of accounting: why do we keep financial record? Why do we account for past transactions? I told you earlier on that the purpose that accounting is centered on accountability. The watchword for accounting is accountability. So accounting is an art of recording, classifying. So we're recording, classifying, summarizing, and analyzing the financial transaction of a business. Okay, accounting transactions classified into related groups of categories. Accounting transactions are classified into related groups of categories. The transactions can then be recorded in the books of original entry. So, not only recording, we classify these transactions into various categories as established earlier on. Some may be classified to as assets of the business. Some liabilities, expenses. Some we classify them to be what? To be income. So classifying these transactions, we now moved forward to what? To try to summarize them, try to get the aggregate expenses, try to get the aggregate income, try to get the assets, try to get the liabilities, such that we can provide the financial statements to the end users. Now, when we classify these transactions, we try to record them in the books of original entry. We shall come to know what we mean by books of original entry. They are books of first entry. When we get there, we'll try to expatiate more on books of original entry. But accounting transactions are classified into related groups or categories. The transaction then recorded in books of original entry. Thereafter, the transactions are analyzed. So after we have classified the transactions, summarizing them, we go further to what? To analyze them and post to accounts in the ledger. Of course, we get to know the ledger. In accounting, you have two books of account. You have the books of original entry, where we group where we post the entries to first, and after which we then transfer it to the principal book, which is when these accounts are being transferred to the ledger. From ledger account, which is a permanent account for each classes of assets, income, liabilities, or expenses. Thereafter, from there, we can now prepare a financial statements. The financial statement will be prepared: statement of income and statement of financial position. Interpret through development of significant relationship and by way of explanation. So it is from these ledgers that a financial statement originates from. So we start from recording, we classify, we summarize, we analyze this financial information, post them to the ledger, and from ledger a financial statement can be further. Let's move in properly to bookkeeping and accounting.